This is a production of the Michael Parsons Trading Institute. All rights are reserved. No duplication or distribution is permitted without written authorization. Michael Parsons Trading Institute presents Balanced Dynamics, the video series. Disclaimer required by the CFTC: the trading of any financial instrument is risky and can cause substantial loss, including the trading of futures, stocks, mutual funds, or options. The use of stops may not limit losses to the intended amounts. Only risk capital should be used to trade futures, stocks, or options on futures or stocks, or mutual funds, or any other financial instruments, whether in conjunction with this product or otherwise. All investments and trades carry risk, and you ultimately make all trading decisions, and you are solely and individually responsible for the decisions and the results of those decisions. Past performance is not indicative of the future results. Not all trades were executed in the actual markets, and the impact of the results can be over or understated. The results and sources are believed to be reliable, but no assurance is made for accuracy or completeness, and is subject to change without notice. You must be aware of the risk and be willing to accept them in order to invest in any financial instrument, regardless of the market. Don't trade with money you can't afford to lose. This is neither a solicitation nor an offer to buy, sell any financial instrument. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed in any of our trading materials or websites. In other words, if you risk it, you can lose it. Balanced Dynamics, video number 1. Basic Concepts, Part A. Why use Balanced Dynamics? As a trader, you may be asking that question, considering that it takes a little effort to learn how to use this technique. Well, the reason is this: balanced dynamic targeting tells you 4 key elements that can enhance and benefit your trading in a dramatic way. 1, it tells you which trades will be the most profitable. Something that obviously you want to know. If you knew which trades would be the best, well, you certainly would be there for them. 2, it tells you where and when you should buy and sell. And this is a key to trading success. Even if you're right about the market, you still have to be there at the right time, the right place, at the right price level to buy and sell to extract a profit. 3, it tells you the trades to avoid. If you knew a trade was going to lead to a catastrophic loss, obviously you would avoid it. You can make a lot of good, successful trades only to have one catastrophic loss take it all away from you. Obviously, for success, those trades you need to avoid. It also tells you the overall bias of a market. Knowing the bias of the market tells you where you can enter in with the least amount of risk, with the greatest profit potential. Balanced dynamic targeting is of great benefit to your trading. One of the questions that come into play here is that whether or not it's actually possible to predict what the market will do. While we often hear cliches indicating that that wouldn't be the case, the truth is something else. Everything in our universe is based on physics and on mathematics, and there is a physics of the market geometry that we can rely on and use to our benefit. The market itself is based on geometry, the universal language. Being so, there are certain action-reaction principles that apply that are basic physics principles. You have a certain action, then you can expect a certain reaction, and this can be key to telling us what the markets will do and how we can take advantage of it. And 3, the market chart is in fact a form of a language. Learn how to read it, and you have an understanding of what the market intends to do. The balance of power is the key point here. In the universe, balance is a natural action. Everything has a balance point or a central point where everything has equilibrium. Consider this pendulum, for example. You leave a pendulum alone, it will sit at the same place and remain unaltered. Extend it out one way or the other, and then release it, and what happens? It will continue to swing approximately the same distance in the opposite direction of its central balance point, where it would naturally be sitting idle. This reaction is something predictable, and like the market, there are certain balance aspects that enable us to understand how the market will react and to what degree. The balance point, then, is a reference used to calculate the reaction an extreme move will have. These are the key elements that we'll be looking at and considering how to do as we proceed in these videos. But this point is important to understand. Balance occurs everywhere. Balance can be achieved even in the most unlikely of things, such as these rocks that you see standing on end. Does that seem impossible? Well, to the average viewer who sees a stone lying down, they may consider that unlikely. But obviously, it can be accomplished. In turn, balance can be found in the most unlikely of things, and as such, it exists everywhere. Finding that balance is a key to understanding the markets and reading where it will naturally flow to in the future. So let's learn about how to read the balance within the market. Along our exploration of the balance within the market, we'll be able to answer these questions and learn this from this video series. 1. Why does balance dynamics work? 2. What is a balance point? 3. How do you identify a balance point? 4. How do you determine a price target? 5. What is an inverse and what does it do? And 6. How do you actually trade balance dynamics? Before we begin to cover all the details of balance points and how to identify them and use them in real time, let's take a look at an actual balance point and see the difference it would make to you as a trader. An example that I'm looking at here in a 30-year T-bond, and I'm currently looking at a daily chart, we see a balance point actually right here. If you look at it, you'll see that it has a contrary wave pattern, and many balance points do have that, in fact, a contrary wave pattern, and there are specifics to help you identify these patterns in real time. But not all balance points are this way. Some may be a gap or some change in momentum, and we'll talk about the differences later. But this is by far the most common form, some type of contrary wave pattern, or where you see a point of indecision in regard to the market movement. Here the market had trouble after seeing a nice move upwards of determining whether the market will go up or down, and you see a battle occurring. Oftentimes there will be a split in the pattern that occurs, as you see here, and from there the market moves higher and establishes that it's a separation or a pivot point for the swing itself. Many balance points are points of indecisions. In contrast, some are also a momentous decision point, or where you see something like, for example, a gap occurs. The market moves higher and then jumps a certain point, and that becomes a balance point. We'll talk about the differences a little later on, but let's see how much of a difference this and identifying it would make in your trading. When we look at this pattern and we find a central location, we find that it has a bit of a split through it, and right here there's a central point. That central point is key to two different future calculations: where the current trend is going and where the future swing will occur or move to. An example can be seen here. If I take this tool and slide it up to the halfway point, as you see here, and this is doubled because this is a 50% level of this entire tool, you can see that the market, after leaving its low, moved up a certain amount, and simply doubling that gives you what? Amazingly, the actual high. But this doesn't stop here, because we can turn around and also take a prior high and run it through the same pattern at the same location. And what do you end up with? Well, amazingly, you end up with the swing back down, where it also reacted and moved higher. So if you were over here looking to make a trade and you saw this pattern develop, you would have known that price would be moving to this price level up here near 99. In turn, you would also know it from there would be swinging back down to around this 92 area. So obviously, that information is pretty dramatic to know in regard to your trading. Knowing this in advance, well, what would have meant to your profits? Obviously, it would have meant a substantial profit to you. this is just but one example of the power of using the balanced targets. As we go through, you'll see many more examples, and you'll learn how to identify the patterns and what to look for, as well as how to compensate for distortions that exist in the market and inverses that occur. For now, though, we just want you to take a look at this and envision what you would have done had you been able to do this yourself. Obviously, it would have made a dramatic difference. Now that we've seen what a balance point can do for a trader, let's examine the patterns that fall under or would be classified as a balance point. There are three categories that we're going to focus on: the contrary wave pattern, the gap or momentum pattern, and the directional change pattern. Of these, even though there are several patterns that we can look at, the contrary wave is without question the king of the balance points. The majority will fall under this category, and typically will be a zigzag or flag pattern. Included under this category is that of the mirrored trend. The gap and momentum patterns will be a little less common, but still quite frequent. You will find a gap or a brief overlap. Also, the fast move or a momentum change. The directional change pattern becomes less likely or less common, but still are important. They include the 90 degree, the flat line, the trading range, and the channel break pattern. And we're going to take a look at each of these and identify what we're talking about and how to identify if they are in fact a balance point. The first two patterns we're going to look at is that of the zigzag and flag pattern. The zigzag is actually a very common pattern for a balance point. More often you will find it in this form than others. Typically it's referred to as a sideways Z pattern because of its appearance, but it's definitely a point of indecision when the market had a hard time determining whether the market was going to go higher or lower. Oftentimes you see the market move 2 or more times against itself before completing its swing or trend. Another characteristic of this pattern is the fact that oftentimes there will be a low that targets a high or a high targeting a low. And if you take the center swing of the pattern itself and divide it, quite often you will see that the low targets the high or the high targets a low, depending on which direction the trend is swinging. This in of itself divides the swing, and is an important key to where the central location of that balance point actually is, and that we would use for calculating the swings themselves. A flag is something that most of us who know patterns in trading would recognize. A flag or pennant is a very common development in a trend, and it is nothing more than where the market moves against itself. This too can quite often become a balance point. The final version of a contrary wave pattern we want to look at is that of the mirrored trend. Now we refer to it as a mirrored trend because typically you can take the first half of the trend and actually flip it over and get the second half. We'll show you why in just a moment. One of the unique characteristics about the mirrored trend is that it really is just a complex version of the zigzag or flag, nothing more. Typically on the quarter point level and 3/4 point level you will see one of these patterns. For example, here you will note that there's actually a zigzag pattern that forms here at the quarter point level, a quarter length of the swing, and you have a high actually targeting a low. Now it could be a flag pattern, but quite often it is a zigzag pattern. In addition to that, you will see a zigzag pattern at the 3/4 point level, again with a high targeting a low. Now obviously neither one of these are in the center of the swing, but because there are two, they identify the actual center point, which is somewhere between them. And often it will be a small pattern, which might include a slight overlap, a gap, or some other significant indication that is used to identify the balance point. And often too, you will see that it actually targets the two patterns or connects them. For example, here you would have a high connecting a low between the two patterns. This is typical in regard to a mirrored trend. Now while this appears rather complex, when you see it in reality, in actual market usage, it makes a whole lot of sense. It's not really that complex. But for now, we just want you to take a look at this and understand that this is a complex version of it, and the most complex that you will see in any of the patterns that occur. Still, even with this, there are simple rules to identify and simplify the pattern. The next series of patterns is that of the gap and momentum patterns. Now, the gap pattern is fairly easy to understand. The market's accelerating or moving fast. It jumps over a price level, creating a gap, and it continues on. That gap, if of itself, becomes a balance point. Now, not every gap is a balance point, but many balance points are in fact gaps, and we'll help you to identify which is which. The next is the overlap, or what's currently referred to as a brief overlap. And the reason for that is that the market accelerates, creating a fast move, but on the following bar it kind of overlaps itself before continuing the accelerated move. That brief overlap is in fact the balance point. And again, we'll talk about that in some actual examples later on. The third is that of the fast move. Now, the fast move is a situation where the market is generally running at a set pace, but all of a sudden you get a very strong accelerated bar far beyond normal for the market that acts as a single one-day or one-bar move, and the market resumes a more normal momentum or movement. Although there's no central point within that bar, you simply take the very center of it and divide it in half, and that becomes your balance point. Again, we will see actual examples later on. The momentum change actually has two versions. It's a situation where the market's moving at a set pace of momentum and then suddenly accelerates very fast. Where there is a division or separation between the two different momentums from slow to fast is where the balance point is actually at. It can also be in the reverse direction. You can have the market moving very fast, but suddenly it slows down. And so that division becomes the balance point. And we'll look at some examples of that as well in the market. The last category that we're going to look at is that of the directional change patterns. And at least with the first three, they're basically consolidations. As you look at these patterns, you may be saying to yourself, well, what's the difference? They all look the same. Well, there are some slight differences, but the key is that while the pattern themselves is not greatly significantly different, how you determine the central point as used as a reference for calculating the future swings will be slightly different. For example, in a 90 degree, as its name entails, basically the market moves up or down, and it takes a 90-degree turn to move horizontally before resuming the trend. Now, sometimes that pattern is quite lengthy, but typically you will have some type of division in the pattern that makes it clear where the central location is, and that reference point will be used for determining or calculating the swing that will occur. The flat line is a little bit different. It's similar, but it's so narrow and with so little different in activity between the highs and lows that no clear dividing point, as you see in a 90 degree, occurs. While here we show all the highs and lows the same, typically in a real market they will not be exactly the same for the entire length, but still they won't provide a clear point of reference where division occurs. In such a case, you simply have to take the very halfway point of the pattern and use it as a reference. A trading range can be quite lengthy and typically has many swings. And like a contrary wave pattern, we'll have situations where a low will target a high and a vice versa high target a low. Somewhere in the pattern there will typically be a division that clearly shows as a point of reference that's central to the pattern, and that can be used to determine or calculate a future swing. So in both of these cases of the 90 degree and the trading range, there should be a point of reference for calculating the swing. Whereas a flat line, well, you have to use a central location. The final directional change pattern that we want to look at is that of the channel break. A channel break, of course, is not a consolidation pattern, but rather a change in direction. You have a market trending in a specific direction, and so a trend line is established, or a channel line. Established off the prior lows or highs, depending which direction the market is trending. When the market breaks that trend line, well, then you have a balance point. And typically there will be a wider pattern to develop within that realm to establish an actual balance point, often with a low targeting a high. While not always the case, the fact is that where the channel breaks, typically there will be a pattern or point establishing a balance point. So let's look at some of these patterns and find out what they look like in real market action. Obviously, they're not going to be as perfect as the drawings we provided, but the basic principles apply. For example, here we have actually a zigzag right here of a balance point. The market forms a low down here, moves higher, forms a high, drops off, goes higher than the prior high, again draws back down before resuming the trend and finishing it out. This zigzag can also be seen targeting itself by taking the high and targeting the low opposite it. And the center point, well, is found somewhere in the middle, as we see right here. Once you locate a zigzag and then the center point of that zigzag, you can use it for calculating where the price will swing. For example, we can take the prior low and center it on the current center point of the zigzag, and we end up with our price target up here. You can see how well that worked. In addition to that, we can use it the opposite way and using a cross-targeting method. We take a prior high and target it through the balance point to end up with the price where price would swing back down to and react to. So this is an example of a zigzag. Some are better defined than these, but basically this is the principle as we discussed earlier. The market zigzags, creating a situation where you have somewhat of a sideways Z pattern, and oftentimes it will target itself with a high targeting a low or a low targeting a high, and then resume the trend once more. The center point of that pattern can be used for targeting. The next pattern is that of the flag. Now, the flag can actually come in quite a variety of different forms. It could be a flag, it could be a pennant. You could even have a sharp pullback where the market resumes a trend. The characteristic that all these have connecting them is the fact that the market's been moving in a trend or swing and comes to a pause or interruption in that movement, and it's quite distinct. Oftentimes you will see a difference by means of a trend line, where you can draw a trend line following the activity and it's broken, and so it contrasts with any other pause in the market that you would see. In such a situation, again, you can take that pattern and find the center of it and use it to determine your swing or move, as you do here. Here we end up with the low of the swing. Here we have an example of a mirrored trend. Now, a mirrored trend tends to mirror itself, but the key point that we want you to bear in mind at this juncture is the fact that you have a contrary wave pattern at the quarter and three-quarter level. For example, here, if we look at this swing from this low to this high, we have a contrary wave pattern that occurs right at about the quarter point level, and also at the three-quarter point level, as we see here, another contrary wave pattern. Now, obviously, neither one of these patterns is in fact the balance point. The balance point is centered in between them. So you're looking at the swing that runs from one pattern to the other to locate the actual balance point. Somewhere in there, you will find the balance point. But how do you determine where in that swing the balance point exists? Well, often there will be a pattern or division, a separation that exists. In fact, if you look at this, you'll see that there's a point where you only have one bar you're crossing through. And we'll talk about the specifics in dealing with that. But that is one sign you'll look at. Another common characteristic of mirror trends is that the two patterns are still interconnected. For example, here we can connect this high to this low to help us locate where the balance point would actually be. And simply using that enables us to take the next step and determine where exactly the swing will go. As we see here, we have a calculation right at about the top of the whole swing. Very accurate and very practical for a trader to use. The details of how we'll use this complex pattern we'll cover a little later, but it's as simple as this. This next balance point is rather easy. It is the gap. And most of us know what a gap looks like. In this case, it's a simple matter of taking the gap and using that to locate where price will go, as you see right here. Very effective. Now, as a reminder, not all gaps are balance points, and it's important that you understand the difference, and we'll talk about those a little later on. But for now, you can see the effectiveness of the gap as a balance point. The next balance point we want to look at is that of the brief overlap. Now, the brief overlap isn't something where we have a brief overlap of any bar. Typically, what we're looking for is a market that's moving strongly. A case can be seen right here. Now, if you look at this, the market has a very strong decline, and the two bars that we're focusing on, this one here and this one here, are very strong in relation to the other bars around it. Now, you have some examples, such as this bar or this bar, where you see a similar length. But the majority of the activity of this market, well, it's much more narrower. It's not showing or exhibiting the same amount of strength. So it's very clear that these two bars have within them a very strong bearish indication with them. And yet, in spite of that, they hesitate right in this area. In fact, if you look at this particular bar, you see that it declines all the way down here and then proceeds to pull back up to close at this level. This bar opens here, pulls back up before declining way down here. A pretty substantial move, and yet still there's a brief overlap with indecision exists. That indecision or point of overlap is in fact a balance point. In fact, we can use that to target our down move, and what we end up with is a move down here. Now, it does proceed a little bit lower, and eventually the market does decline further, but for this particular leg of the market, you can see how accurate it was. If you were selling from up here, exiting down here, anywhere in this area, well, you certainly would have done very well. But this is not the only example of a brief overlap. Even though it's not a type of balance point that we need to focus on greatly, let's take a look at another example just to make sure we get the idea. Here's a nice example of a brief overlap. Gives a typical example that you're going to see. Slightly different than what we saw before. In this case, you see that they close at the exact same level as the open of the following bar, and of course they overlap one another slightly. In both cases, as you did before, you see that the bars involved exhibit a very strong trending or a very strong move. And this is what you're going to be looking for in regard to any brief overlap. But again, there is a brief overlap, a point of indecision, and that marks the point where the balance point will occur. Now, this trend is a little longer or more extensive than just this one half a leg that we're looking at. But a balance point will occur in a half on each leg as well as the full length of any trend or swing that you're looking at. And here you can see the balance point here. We end up with a target up here. Obviously a great point to take profits on this swing before it consolidates. And of course later it does move a little higher, but for the time being a great target to know and to take advantage of. And this is a common example. This particular example of a brief overlap is one of the more common versions you run into, where the bars actually line up with the open and close and have a brief spike or short spike that exceed and cover one another. But there are other versions as well that we will look at in time. Before we leave the subject of brief overlaps, there is one other version that I want to touch on, and that's where there's an extra bar in place. Typically it's a doji bar, as you see this. Now, a doji bar is nothing more than a bar with a similar open and close, almost like a little cross, a little plus. And sometimes it can be long one way or the other, but oftentimes it's much smaller, as you see this bar right here. And whatever the case may be, you still end up with a similar situation as you do with any type of brief overlap. You end up with a couple of bars that, well, typically are a little bit longer than the average. They have a close in one case at one level, and the bar that sends it the rest of the way opens up at a similar level, and typically the doji bar will still have the open and close at the exact same level. It's like there's a complete line there, horizontal line that divides the activity of the trend. And even though you have one additional bar that separates the two, they still remain as a brief overlap of one another and still continue the actual market. And you do nothing more than what we've done before. You simply determine the target as you would have on any other case, and you have the price level you're looking for. And you can see how well and effectively that works. The next balance point is that of the fast move. Now, what is a fast move? Well, first off, there are a couple of qualifying factors, and initially when you look at this it may sound a little confusing, but it's really simple if you follow two specific rules that you bear in mind. One, it's going to stand out as substantial. You look at this bar right here, and if you look around it, you don't see anything that compares with that in the majority of activity within the market. It is substantial for the market, and so it must stand out as that. If you have a substantial move, then that may qualify as a fast move. But there's a second qualification. If you look, this bar below it also has a pretty substantial move. In fact, it's very similar in length as the one that we're looking at or focusing on up here. The problem with this is that you also have consolidation, bars surrounding it. That's the same basic level. Most of the activity that runs in the center of this bar is filled with other bars also. That amount of extra bars included that create a consolidation exclude this from being used as a fast move. So those two rules, a fast substantial move that's out of character for the market and no consolidation in the body of it. Now there can be a little bit of overlap in the beginning or at the end. There can be a consolidation before or after. And as a reminder, as a point that you want to bear in mind, oftentimes a consolidation will follow a fast move, so that's not uncommon. But the majority of the bars should be clear of activity, and it should be substantial. So how do you use a fast move? Well, you're going to take the bar itself that creates the fast move, and you're going to divide it in half. Find the central location. You can use a tool like this. You can take a measurement. However you decide to divide that bar, you simply split it in half. From that point, you are going to use that as your central point of the swing. Take the beginning high or low and use it to give you your target, doubling whatever that halfway point is, and that will give you your target as you see right here. And you can see how perfectly this worked. Ideal. And this is common. Just simply find the central location or central price of that one fast move bar and then use it as a gauge for the rest of the move. You'll find out it will be extremely effective. The next form of balance point is the change of momentum. Now, change of momentum, because there's such a variety of different forms, we can't possibly cover all of them in an introduction alone. But the basic concept is this. You have a consolidation that occurs, and then the market takes off rapidly. Where that division exists is, in fact, a balance point. Or perhaps you have a market moving very fast, and then it comes to a halt and creates a consolidation. Where they divide can be a balance point, which may indicate how far the market will go up before it finally starts to decline. These are the factors of the basic concept. Typically, there will be some type of indication at the point where that divides. Sometimes there's a pattern, a contrary wave pattern, or a gap, or something out of ordinary. Oftentimes, there'll be a point of where there's a slight activity where the market bounces in a narrow range just before breaking. And that's what we have right here, because if you look at this, we have a consolidation in this area here. It's actually a triangle pattern, and for anyone who monitors or uses patterns, you should have an easy time of finding this one as you look at this triangle pattern that developed. It wasn't that hard to read. At this point, it begins to move rapidly down. It does bounce off of a low, come back up and make one final attempt to move higher, to only bounce off of that trend line and then move rapidly downward. There's a definite division that happens right here. In fact, if you look at it, there's actually a contrary wave pattern here, so that of itself gives it away. Typically, there will be some type of indication of a division between the consolidation and the accelerated move, the change of momentum that you'll use. Now, in this case, the focus would be right at the break. And you simply use that using the prior high or low, such as the high of this consolidation, and bring it down and use it right where it breaks. And that would give you your target, as you see right here. And you can see how effectively that worked. It's just that simple. The next series of balance points we want to talk about is the 90 degree and the flat line. Now, typically, the 90 degree is what you're going to see more often than the flat line. Flat line typically shows up in a stock that perhaps may have reached a peak and sits there for quite a long time. Basically, it is extremely flat. This comes close to a flat line, but it does have some activity that divides it or separates it in swings. This I would consider kind of in between a 90 degree and a flat line. This is, by the way, the Globex for the S&P on a 30-minute time frame, and this happens simply because of lack of activity during the overnight hours. Flat line and 90 degrees are long periods of time that the market sits at a certain level within a tight range. They're kind of narrow, so unlike a trading range, you don't have as many swings that you can eyeball and determine where the market or the line would divide. And that's what you're looking for in one of these type of scenarios where there's a 90 degree or flat line. Flat line doesn't give you much of anything to work with that you can really put your finger on. A 90 degree, on the other hand, will typically have a swing, kind of like what you see right here, where the market raises up, falls back down, and raises up again, creating a slight Z pattern, zigzag pattern that divides it and separates it and tells you that there's something going on there. It's like a guide where you can actually take a line and go through that section to give you a target line. And the lows that line it up as it moves up in one direction or down one direction, and the following highs or lows that guide it, created a kind of a division where it guides through and gives you your target. And you can see where we end up right here, right at target for this. Even so, on a mathematical scale, the target ends up a little bit more, so there's more indication in here. Because if I were to split that, well, you end up with basically right where you see our high that occurs over here. So there's actually two calculations that it's giving to you to work with. And we'll talk about the complexities and how to use these different targets in your trading later on. For now, though, you can see that it is rather effective. The flat line, unfortunately, doesn't give you this type of division in order to work from. You're basically facing a very flat, nondescript line, and it's impossible to find a central location, at which point you just have to use a central point of it if you were to use a target line. If you're using a mathematical line, then basically it ends up the same way as you do with a 90 degree. Take the halfway point of that line and use it as a halfway point of the trend or swing. Now, there will be some variations. Typically, you will have additional activity in the market later on that will help you refine that. So it's only a gauge to use as a guideline to determine where to take profits. But this is one of the factors in regard to these flat lines or 90 degrees. A trading range is a little bit different. It gives you a little bit more information. So let's take a look at a trading range next. The final balance point we're going to talk about in this introduction is the trading range. Now, there's a couple of things that make the trading range an appropriate finish here in the introduction. One, it is a very common form of balance point. And by the trading range, we're talking about something like what we see here. You will see it quite often, although not as often as a zigzag. It still is a pattern that you see in frequent trends and swings. It has in it a number of factors that make it easy for you to work with. So it is a plus to the fact that if you find a balance point that is a trading range, it's pretty easy to work with. In our use of the trading range, some people are very detailed in requiring that a trading range have exactly the same highs and lows. We're not looking for that. We're looking for a range that is remaining within the general area between highs and lows and its development. If it's slightly inclined upward or downward, it's not an issue. The important thing is that it is a range that you can identify. The advantage of the trading range as opposed to the flat line or 90 degree is that you have more well-defined swings, meaning that you have the ability to use those swings to determine a guide or path. Now, during the course of these introduction, these patterns, most of the examples that we show in giving you a price target is based on doubling the distance or using the mathematical calculation. And that applies also here to this trading range. But there are two ways to determine a target. And one is also through a target line, as you saw briefly in the last set of patterns that we looked at. The same thing applies with the trading range. First off, let's look at the first calculation. If we take the high and use a halfway point on the pattern, and one thing that we want to look at if you're going to use this method with a trading range is, similar highs and lows that would guide the pattern. And you can see there's a series of highs here, high here, low here, low here, low here. And though it spikes down, most of it is in the general area. In fact, I can actually bring it down just a hair more. But it's right there. You can see it bouncing in between the pattern. What it ends up giving us as a target is right here, and you can see how powerful that was right where the target is at. But this is not the only way we can target it. You see there's also a target line that goes through, and typically there will be a guide to that. Lows and highs that will guide it through. What is the natural path for this to go through? Well, there's a high here that can be used to support a low as direct the target line, another low to work from. Now, while this is subtle and something you will have to learn as we go along, if you look at this and you guide it through, you can end up with a target line like this, and you actually have a separation or gap right between this bar and that bar that perfectly lines up. And what do we end up with? Well, a target right here where we hit and reacted off of. This is common, and so the advantage of the target line can be seen here. With both of these working together, you know exactly where price is going to go and react off of. But this is an example of a trading range and what you would be looking for and how you would use it. Again, this is just one of the many examples, and we'll see a lot more as we go along through the course of this training video. But these are the examples of the patterns that we identify as a balance point. Balance Dynamics, video number 1. Basic Concepts, Part A. All methods and techniques are those developed by Michael J. Parsons. The videos are narrated by Michael J. Parsons. Director of Marketing, Osman Musa. Technical Support, Melissa R. Parsons. Accounting, Ray V. Parsons. And Translation, Heather L. Parsons. This is a production of the Michael Parsons Trading Institute. All rights are reserved. No duplication or distribution is permitted without written authorization.